Welcome to another episode of What's on Your Mind. I'm Chris Quill. Joining me on the show today, I've got Jason McDonald and Raj Malhotra, both ITPM senior trading mentors, of course. Gents, it's a pleasure to have you back as always. We were actually just chatting offline just before the show, Jason, and you had some really interesting market observations that I thought it would be great to share with our viewers. So why don't you take us through those to start with?
Yeah, first of all, hi everyone. So really it's kind of following on from something that we touched upon a couple of episodes ago when I was on previously. And really, and also these thoughts, I was formulating over the weekend. So, of course, we've now been slightly overtaken by events with developments in Italy and elsewhere. But generally what I was discussing was the fact that we've seen all these things rallying simultaneously in terms of bonds, low volatility stocks, momentum stocks, tech stocks, and just really I just wanted to throw out a few sort of stats, as is my kind of want, and just for people to kind of reflect upon and just have a think about. So we hear the word bubble so often, it's become very tired. But just to sort of put a few stats out there, if we look at, for example, the technology sector within the S&P, in terms of that on a ratio versus energy stocks, and we know why this is the case, but we're now looking at kind of levels where we've only previously seen during the dot-com, I'll call it a boom rather than a bubble. And as we know, we talked about liquidity a lot on here before, as macro obsessed people do. We know there's tons of liquidity out there, and so what you've seen is this rather strange thing where you've got secular growth, i.e., tech, which kind of makes sense, really, very strong. But you also see bonds strong. Why? Because obviously interest rates are low and going lower. But also things like the defensive sectors, which we talked about before as well. So things like the XLU, which is the utilities ETF. Now, in days gone by when, even I was young and maybe Raj was just a glint in his parents' eye, we used to have, you'd have things that weren't correlated with each other. So, for example, people would buy utility stocks and other kind of, in inverted commas, defensive stocks as a kind of a portfolio protection type thing. But what we've seen recently is, everything's been moving in kind of in sync with each other. So this is all the way. This is the way that the market has really changed in terms of kind of passive indexation, momentum strategies. Moving away from discretionary management to more passive management, which has basically meant loads of funds and liquidity pouring into kind of mega caps, low volatility stocks. We've also got a new category now, ESG, which I'm sure everyone's heard of, environmental, social, governance stocks. And basically, this kind of exacerbates the crowding that we see. So we've got, if you look at the correlation between low volatility, mega caps, tech stocks, ESG, they're all kind of funneling together. If we look at the HFRX data from January, you saw hedge funds piling into momentum stocks to record allocations. This month, February, they've now also piled into, in inverted commas, defensive, so low volatility exposure, which is also now at a record allocation for hedge funds. And in the latest Bank of America fund manager survey, you've got a very large increase in allocation to tech, even from January, where the allocation in terms of the overexposure, so overweighting, was 31%. It's now up to 40% in February. So, we're seeing this kind of herding, crowding behavior. So what I was thinking, and this was before the coronavirus developments, so it needs probably a little bit of tweaking on that front. But, what I was thinking was that, it might be, if you remember last September, we had that kind of, we had quite a an abrupt switch. And I think I was talking to you about it at the time, Raj, maybe just afterwards, when people went out of growth and into value, and possibly cyclical. And I was just wondering, whether we might see that type of rotation, which was very violent and very rapid. Whether we might see that type of rotation again. So I was really thinking on the lines of kind of long value, cyclical. Now, if you're brave, that kind of means, looking at things like long EEM, which, as I say, especially given the coronavirus developments, that would be a brave move at the moment. But looking at on the other side, possibly being short XLU, triple Q, that type of thing. HYG, which is the high yield ETF as well. Just kind of following on from when I was on here last time, the CTAs, so the commodity trading advisors, they're still very overweight equities. They've been piling in, they've continued to pile in February. If you look at, as Raj and I have witnessed many times before, unfortunately, retail traders are normally late to these parties, and they've been piling into call options, as we can see from the data. So really, I'm just kind of reiterating what I said before, which was I think, downside risk does need to be hedged to some extent, that you do need to employ things like rolling stop losses. I don't want to labour the point too much. The other thing that occurred to me as well was just this US-centric versus rest of the world allocation as well. If you look at the MSCI USA index, the market cap for that now is $28.5 trillion versus the MSI World ex USA is around about $16 trillion, which means that essentially the USA market cap now speaks for about 64% of the kind of developed world equities. The previous record for that was back at the end of the dot-com boom when it got to 59%. So I'm just wondering whether, we need to be looking at doing some switches. As I say, we had the developments over the weekend, which I know Raj is going to definitely, have something to say about. So, maybe the long side of that, you need to tread carefully, especially if you're thinking about, cyclicals and value. But, that would also be a kind of counter the trend at the moment. And I think, when you look at the moves that we saw yesterday, you can see what happens when when people start to, take a little bit off the table in some of those crowded areas of the market.
Raj, what about you? How does that line up with kind of how you're looking at markets as well at the moment?
Yeah, first of all, thanks, Jason, for being so politically correct and calling the tech boom not a bubble. That's it's very millennial of you, despite your despite you look a little older than most of the millennials.
Yeah, I'm just looking to try and update.
The PC police is over here. Thanks everybody for tuning in. One thing you were talking about that intrigued me, we were talking about value versus growth. I remember we talked a lot about this. I think this was back in late 2018 in Thailand, and as you remember, that basically would happen very late in 2018. The pile into defensives versus growth, and you saw all those names were tremendously on sale. If you look back, you could have bought Apple, even a big cap name like that, at under $200, and look at where it is now. In terms of, and I think a lot of that had to do with back then was also in terms of the time of the year, especially with mutual funds that are forced to own stocks. When they saw these growth names in their years getting kind of destroyed late in the year, knowing that they had to own certain, mutual funds are required to be fully 100% invested. So as they were selling growth, they're buying value. They weren't necessarily buying value back then because they thought value was had more upside. It was just because they had less downside. Buying Kimberly-Clark, even in a recession, hopefully people will still use toilet paper, which is, a cloud computing name. So, but in terms of what you talk about emerging markets, you're actually right. I mean, for the first time in a long time, emerging markets are really quote unquote cheap. But I would like to buy those, 10% up from here. Kind of like I'd like to rather than try to pick the bottom. I would like to already in my mind seen the bottom.
Yeah.
potentially, I think those some of those stocks have 100% upside. So I'm fine missing the first 10, 20%. Rather rather get on the way up than the way down. But I do think that's a that is a trade. And like you said, you talked about coronavirus. I think that's going to be a drag on those stocks and certain other names that are going to be like that for a while. So I'm not looking to bottom feed. I'm not looking at bottom fish and airlines and travel and cruise lines yet. I'd rather, like I said, I'd rather buy those on the way up rather than catch a falling knife.
Yeah.
But like when you talked about coronavirus, I want to talk a little bit about this because I want to, it comes through. A lot of my mentees ask me questions about this. I want to make this point very clear. The market didn't really care too much about coronavirus until it hit Italy. So maybe it stopped. Now it hit white countries, not just Asian countries. And that might have spooked the market. But I think the most important thing, in all seriousness, the most important thing to consider is it's not the amount of deaths or cases, because that number is somewhat arbitrary, and really it's not that important. What's most important is that the market views this that's contained to a Q1 event. Because that's why I feel that's the way the market's pricing it right now. As long as it's contained in Q1, as long as in Q2 we're not talking about coronavirus anymore. I think that's what the market's expecting. If we're talking about in Q2, Q3 about the number of deaths, then all bets are off. But I think that's really what's important, because if you look back at the SARS outbreak, if you look historically, it was basically a V-shaped recovery. When the SARS was GDP went down everywhere and it went straight back up the next quarter. So all of this can catch up to a Q1 slowdown. So as long as not a long-term drag, I don't think we're going to be really talking about this too long. It's an exciting name. I'm not saying it's not a worrisome thing. I think one thing that's important to notice about it specifically, it's actually not affecting children, which is actually really important. And it kind of shows the weakness of it. And remember, kids are much more important in long-term economic growth than a bunch of old people dying. Some people might argue that's a good thing. Not me, but some people might.
I'll call you Malthus.
Not you, Jason. You're all right.
No. I was checking the numbers yesterday. I'd be worried if I was over 70, but I'm not quite there yet.
Right. But you know what? Actually, here's one stock that I really like. That it's funny. Jason talked about ESG, environmentally, whatever. I don't know, whatever the young people like to call it. Other
environmental, social, and governance.
Exactly. Okay. Exactly. That's what you said. So one name that I really like is DocuSign, DOCU. DocuSign is a company that basically their main product is basically signing stuff. It originally started as like real estate and like real estate contracts where you can sign them online, and that's expanded also to, if you ever open a brokerage account, you probably know how many pages you have to sign. Well, your signatures have to be everywhere. With almost any business model now, everything has to be signed especially finance, for compliance purposes. But if you look at this company, their EPS is growing massively every quarter. Their revenue is expected to grow 38% this year, another 26% next year. Their earnings increased 167% this year, another 75% next year. It's compounding at a very high rate. And the most important thing is it's released new products with its Salesforce integration. So basically what's going on is it's now into the Salesforce program, which is as software as a service. That's what most companies are using software as a service, but Salesforce being one of the top providers across all companies in the U.S. I mean, I think even in a recession, I find it highly unlikely that as we worry about paper and environmental issues, the eco trends, just being able to sign documents first online and sending back, first of all, is more efficient, meaning that if I send you a document, you sign and send it back to me, we're done. Second of all, we don't have to do this whole paperwork back and forth, which just kills trees. So, Salesforce has very historically been what they like to do is if you follow the history of their company, they like a product, they integrate it, and then they buy it, and then they just fire everybody because it's because that's just the way they operate, and just gives their customers more options, and it gives them more customers, and then they can cross sell everything else. So to me, not only is it a great company on a standalone basis, I think their only real competitor is Adobe. Other people can come into this, but DocuSign is right there in that market. It's in a trend that's not going to go away, and we're not going back to paper signatures. I think it's clear that maybe 10 to 20 years from now, paper signatures signing documents won't be a thing anymore. I think that will just be over. Their earnings are March 12th. I added yesterday with market weakness. I added to my long stock position by buying June 85 calls for under $10 with a break even of 95. I think we can easily get to that just by earnings date. But the reason I'm going out to June and possibly even further, I think this is a real takeover candidate by Salesforce. I think they could easily take it out for $130 or higher, and so I'd like to buy calls further out. And even if earnings aren't where they are, I think that it's an obvious, like I said, an obvious takeover candidate, and I don't see a lot of downside for number one, the trend, number two, the company. And I can't believe I'm saying this. If you ask me 2 years from now, is DocuSign going to be owned by another company like Salesforce or still independent? I think they're going to be bought by someone else. And I can't believe I'm saying that as a man of statistics, since they are right now an independent company.
Cool. So that's on the long side. Jason, should we go over to you? Are you looking at anything on the long side as well?
Yeah. But actually, before we do that, I just wanted to talk about just really briefly a couple of things that previously I spoke about in terms of trade ideas. So not the last time, but the time before, I was a buyer of SAM, which is Boston beer, basically on the back of the seltzer growth story. So it was a real slow burner. And then essentially they had a really good run up so I bought these in the high 350s, around 358. They had a really nice run up ahead of their numbers, which was last week. So the numbers were on February the 19th. And long story short, they bust through $400 and went up to about 430. So I took my position off and took 20% out of that, sold them at 425. Basically the day before the numbers, just on the basis that, given the run they'd had, they were going to have to come out with something pretty special for the stock to carry on. The stock's actually come off since. I haven't taken a close look at the numbers. I'm in no rush to get back in given the general market situation at the moment anyway, but I'll probably go and have a look at those numbers again and see if it's a good opportunity to get back in. And the other thing was, if you remember from last time, I was shorting Grub, GRUB. Essentially, they're basically, where they were from when we last spoke, which was, about a month ago. In terms of what I'm looking at actioning now, so I actually bought some Yeti yesterday, ticker YETI. So that's Yeti Holdings. Basically,
I like that, by the way.
Sorry, you like them? Cool. Okay, so I'm in good company. So they started off a bit weak yesterday, actually bounced off the 200-day moving average. We hate talking about TA, but we have to sometimes. So they closed just below 32, and I got in yesterday below 31. So this company, for those people that don't know it, it's got a market cap just under $3 billion, consumer discretionary stock, but particularly leisure and recreation. Essentially, they're in the sort of hunting, fishing, outdoor barbecue business. Their main seller, the flagship business, is coolers and drinkware. So to give you the valuation stats, so For this year, so for F1, we're looking at a PE ratio of 23 times. For F2, we're looking at just below 20 times. That compares favorably to the industry. In terms of the earnings growth for this year, we're looking at 28% F1 and 17% F2 compared to, for the industry this year, earnings growth rate averaging around 20%. We're looking at also a strong sales growth story here. We're looking at 14% growth in sales for F1 for the company compared to 4% for the industry. So it screens well on that basis as well. Essentially what happened here is they reported on the 13th their Q4 numbers, which was actually a positive surprise on the earnings front. So they had a positive 11% surprise. They've got monstrous margins. They're still expanding their margins. Their gross margins are around 55%. They've got momentum in one of the key areas that they're focusing the growth on, which is direct-to-consumer sales. However, the stock sold off after the results on the 13th because the numbers, as I say, were good, but guidance was, according to some people, disappointing. So the stock really needed to, beat big and sort of raise guidance to go higher. It had a really good run already. It didn't, so the stock came back. They also had a small secondary issue of stock around $32. Essentially, I think this is a good opportunity to get back involved if you're not involved already. Sounds like Raj probably is already involved. The sales growth numbers are extraordinary. They had 23% growth in Q4 last year. They've already guided up revenues by 13 to 15% for this year. The analysts are upgrading their earnings estimates for both this year and next year. The balance sheet is really solid. They've only got 1.2 times net debt to EBITDA. As I mentioned, there looks like there's there's support on the chart, but just below here, around 30.70, which is the 200-day moving average. The company strategy is essentially to accelerate on the international side, which is only currently about 4% of sales. They want to increase that to 25% of sales because this is mainly a North American story at the moment. I'm looking for 20% plus on the stock, so we're talking high 30s, low 40s. What are the risks? Well, the margins are very high, so how long can they keep pushing those margins higher? At the moment, I don't think it's an issue. And of course, possibly, if we, as Raj was referring to the coronavirus thing, if this becomes a Q2, longer situation, maybe we're looking at, global growth scare, etc., which could affect the business on the international side. But at the moment, it's very much that's a promise from them for the future. So that's what I've got involved with those yesterday. I imagine if we continue with weakness in the market and they go below the 200-day moving average, I'm sure that the TA guys out there will have a go at it. I would probably be looking to actually buy into that myself. So yeah, that's my long in the last few days.
Cool, and we'll see if we've got any shorts then. Jason, you've usually got some shorts for us, so any today?
Well, actually, IBM. So we know this company as the Big Blue. At one stage, back in the 80s, this company used to be just shy of 5% of the S&P, the S&P 500. So it's still got a market cap of $130 odd billion, but it was really big back in the 80s. So this company's business model has been going downhill since the mid 80s. Just to sort of backtrack a little bit. So we've got a company here, as I say, it's around $130 billion market cap. Share price got hit yesterday. It's around $150, which is certainly where I'd be selling it. They're in the computing business. They've got 4 business segments: cloud and cognitive software, which is about a third of revenues. Global tech services, which is also a third. Global business services about 20%, and the rest, like 14-15%, is what they call systems, which is where the old mainframes business is. In terms of the numbers, we're talking about, this thing trades cheap as you'd expect. Well, cheap. So it's on an F1P rating of 11 times, F2P rating of 10.5 times. Why? Because there's virtually no growth. Comparing to the industry with an F1P rating of 21 times and 19 times for F2. Earnings growth this year for IBM predicted to be 4%, next year 6%, comparing to 9% each of those years for the competitors. There's basically no short interest in it, so it's not a consensual short. In the last 3 years, from 2017 through end of 2019, you've seen declining revenues, declining cash flow, declining cash balances, declining cash flow from operations, and increasing debt. Let's put some numbers on that. So we've seen revenues fall by 3%. We've seen cash on the balance sheet drop by 30%. We've seen cash flow from operations drop 12%, and we've seen debt increase by 34%. And the reasons for that partly will become very clear soon. It's one of the largest tech companies in the world, but it can't generate earnings or revenue growth. The share price is up slightly this year because they've got a new CEO, somebody they promoted from within, a guy called Arvind Krishna. He's the new CEO, was previously senior vice president in charge of cloud and cognitive software. Last year, to address their growth issues, they made the largest software acquisition in history, which was of Red Hat. That was a $34 billion acquisition. Surprise, surprise, they paid for that with cash. Now, the numbers on this are extraordinary. They paid 10 times EV, so enterprise value to sales, 53 times EBITDA. These numbers are extraordinary. How the hell you can expect to make money out of an acquisition like that? We know cash is cheap, of course. However, so Arvind Krishna, the new CEO, he was the architect of this wondrous deal. Now, basically, they are kind of nailing their future prospects to cloud. Now, guess what? Cloud is not exactly new. We've been hearing from our students about cloud for at least the last 3-4 years, right, Raj? I mean, it's one of the mainstays of a lot of their ideas. So IBM's looking towards Red Hat to bring back the growth by selling subscription services, training in open source software. Now, to give you an idea of the sort of scale of that business, it's really Amazon and Microsoft that dominate that business. Amazon is like 29% of that business. Microsoft is 15%. Even with the Red Hat acquisition, IBM is 2.5% of that market. And this is obviously a market that is definitely maturing. Now, if you look at the Q4 sales growth numbers for that business for IBM, it looks great, 23% in Q4, until you see that, well, actually Amazon grew 34%, Microsoft grew 62%, and these guys are much, much bigger. So long story short, I don't think IBM's going to be eating their lunch anytime soon. I don't think it's going to change anything for them. I don't think it's going to give them revenue growth or earnings growth. I think they're really late to the party. And the other thing as well is that because they took on so much debt to pay for this acquisition, they've also suspended their share buyback program, which, as we know, has been a real feature in terms of supporting stock prices. So for all of those reasons, I'm quite comfortable being short the big blue here.
Yeah, and actually, in one thing that I can tell you anecdotal, I know this for a fact, in terms of their service business, Accenture kicks their ass big time. They just can't compete with them. They can't compete with Accenture in their core business. They can't compete with AWS and Microsoft in their business. They're basically third or fourth place in everything. So there's no participation trophies for stocks.
Yeah. So there you go.
Excellent. Well, gents, pleasure having you both on the show once again. We'll finish up there. I'm sure our viewers are going to take away a lot from that discussion. You guys went through a lot of interesting things, particularly given the current market environment, so I appreciate you both coming on. Now, as always, for you guys watching, I want to mention a couple of events that we've got coming up at ITPM in the next month or so. So 2 webinars and a seminar. The first webinar is on the 29th of February, so towards the end of this week. The topic is trading psychology. That's with Anton Creel, and that's only open to ITPM alumni, so that's students that have taken one of our video education courses, one or more. The second one is on the 5th of March. That's a live seminar in Manchester that Chris Cathy's doing. So any of you from the UK or local to Manchester, do try and get along to that. That will be a fantastic event. And then on the 7th of March, we've got another webinar that is called Making Big Bucks from the Stock Market. A nice bold name. Anton Creel and Raj Malhotra here are hosting that, so that'll be a great one to watch as well. You can find out more details about those events either on our website or below the video in the description. I'll put some links there as well. And the final thing I wanted to point out, which is something I mentioned after our last episode as well, is that if there's any of you that are new to ITPM and you haven't really yet got involved with any of our educational courses or anything like that, then now's actually a great time to do it, because we're running quite significant discounts through our ICDP discount program. And that basically, those are discounts towards our video education courses. So a really great time for you guys to get involved. You also would get a free ticket to our global conference on the 2nd of May, which we're hosting just outside London. So lots of great benefits for you guys to get involved now. But anyway, that's it from us. I hope you guys enjoyed the show, and make sure you join us next time for another episode of What's on Your Mind.